In cryptocurrency, there is a legendary, unbroken mathematical floor that every whale, institution, and mega miner watches with absolute terror. For 17 years, Bitcoin's price has collapsed, bled, and capitulated, but it has almost never spent more than a few days trading below its actual raw cost of production. But in the summer of 2026, as block rewards halved and global electricity grids faced unprecedented strain, the floor didn't just bend, it fractured. 90% of retail traders are currently staring at charts, looking for support levels, completely unaware that the world's largest mining syndicates are already entering a fatal, involuntary welcome to BlockDocs, where we strip away the noise to expose the raw truth of crypto and global finance. Hit subscribe to track the money with us. And let's get straight to the story. To understand the terrifying gravity of a production cost crisis, we have to strip away the complex trading indicators and view Bitcoin not as a financial asset, but as a manufactured commodity. Just like oil, gold, or steel, Bitcoin requires raw infrastructure, massive capital expenditure, and staggering amounts of energy. Every 4 years, a programmatic event known as the halving cuts the supply of newly minted Bitcoin in half, instantly doubling the energy cost required to produce a single coin overnight. Following the latest halving cycle, the global network difficulty reached an astronomical peak. Data compiled by Capitulation Investments and Charles Edwards revealed that the median structural cost to mine one single Bitcoin had surged to an unyielding $62,650. For months, large corporate miners like Marathon Digital and Riot Platforms managed to survive by selling off their historic reserves and leveraging high-end, next-generation ASIC hardware. But as the broader macroeconomic liquidity dried up, Bitcoin's spot price began to drift lower, dangerously hovering just inches above this invisible financial floor. The trap was set, and the market was about to test what happens when the math of security conflicts with the reality of insolvency. The cracks in the foundation began appearing quietly on-chain, while retail investors were hyper-focused on daily ETF inflows and minor regulatory headlines. The raw data guiding the physical network started flashing classic distress signals. Bitcoin was trading comfortably at $65,000, but the network's hash rate, the total computational power securing the blockchain, began to flatten out and experience sudden, uncharacteristic drops. This subtle flattening wasn't a random technical glitch. It was the first wave of small, highly leveraged, and inefficient independent miners quietly unplugging their machines as their daily electricity bills officially surpassed their daily mining revenue. By mid-June, the quiet strain escalated into a visible, structural shift. Bitcoin's spot price broke below the $64,000 threshold, turning what was once a tight profit margin into an immediate operational deficit for mid-tier mining operations globally. In private mining syndicates from Texas to Iceland, balance sheets were radically rebalanced. When a miner can no longer cover their operational expenses from the daily block rewards, they are forced into a brutal capital decision. They stop hoarding their minted coins. Instead, they begin aggressively dumping their internal treasuries directly onto the spot market to survive, creating a toxic, compounding loop of structural sell pressure the traditional order books were completely unprepared to absorb. The true inflection point arrived when the hash ribbon indicator officially triggered a full capitulation signal, a rare macroeconomic event that has historical accuracy for predicting severe market structural pain. This marked the moment where even the industrial-scale, publicly traded mining conglomerates had to capitulate. They couldn't upgrade their hardware fast enough to outrun the rising difficulty. Network difficulty adjusted downward by a staggering 4.5%, as millions of gigahashes of computing power vanished from the grid simultaneously. For those who knew where to look on the blockchain, the message was undeniable. The physical floor had snapped, and the network was structurally purging its weakest participants. As the capitulation reached its maximum velocity, the feedback loop completely tore through the spot market's defense lines. Forced miner liquidations collided head-on, with a complete absence of institutional bidding power, as tens of thousands of physical bitcoins were systematically transferred from distressed miner vaults to spot exchanges like Coinbase Prime. The price violently breached the $62,650 production cost baseline. Within a 72-hour window, Bitcoin entered a pure technical vacuum, plunging straight down toward $50,000, igniting a systemic margin call that completely wiped out billions of dollars in open long interest across derivative desks. This structural breakdown uncovers a harsh, undeniable reality that completely shatters the mainstream narrative surrounding Bitcoin's resilience. Retail investors are consistently told that institutional buying and scarcity alone will guarantee an upward trajectory. But when the price falls below the physical cost of production, the entire system is forced to play a primitive game of economic survival. This isn't just a simple dip in a chart. It is a violent, structural re-architecting of the entire network. The large, heavily capitalized corporate monopolies use these exact capitulation events as an economic weapon. They deliberately allow the price to dump below production costs, operating at a short-term loss, specifically designed to starve out, bankrupt, and swallow up their smaller competitors, consolidating absolute power over the global hash rate. For those navigating these volatile cycles as serious investors, this crisis delivers a definitive lesson in market mechanics that most retail participants ignore completely. You must stop evaluating asset health purely through retail sentiment or retail indicators. The absolute baseline of any commodity market is governed by the relationship between price and production cost. When you see the hash ribbon indicator trigger a full capitulation signal post-halving, it is not a signal to blindly buy the initial dip. It is an urgent warning that structural sell pressure is accelerating. True risk management means tracking miner treasury health, monitoring network difficulty shifts, and knowing that a drop below $62,650 isn't a random failure. This capitulation is a fundamental milestone in the maturation of Bitcoin as a global macro asset. It proves that the network is subject to the exact same hard industrial laws that govern traditional energy and commodity markets, transforming it into a leaner, more resilient system built to survive the next decade. Do you believe the current mining capitulation will push Bitcoin down to the $50,000 mark, or will difficulty adjust fast enough to save the floor? Let me know your thoughts in the comments below.